Hi, my name's Scott Barnard. I'm a portfolio manager here at Westwood on the multi-asset team, and we wanted to hop on and talk a little bit about the implications of investing in a falling Fed funds rate environment. The Fed cuts are finally here. We've been waiting for them for a number of months, and the Fed has finally begun to lower the Fed funds rate. This has implications for all sectors of the market: fixed income, equities, even convertible bonds. So what we want to talk about is how best to invest in a falling Fed funds rate environment. We're going to spend a little bit of time at the beginning talking about fixed income. Then we're going to talk a little bit about equities and lastly touch on convertible bonds. So within the fixed income world, there's obviously the direct beneficiary of bond prices, which outperform when yields move lower. Now, as the Fed starts to cut rates, this has the most direct impact on the front end of the yield curve, meaning shorter maturity bonds. The Fed cuts will likely bring these down lower, and the longer end of the yield curve, meaning 5s, 10s, 30 years, will most likely move lower in tandem. We do typically see a positive correlation between Fed funds rates and longer term bond yields, but there's a little bit less certainty with the longer end of the yield curve. Some of the sectors that will benefit the most are some of the obvious ones, treasuries, corporates, mortgages, municipals, and these will likely perform well as the Fed begins to cut rates and the yield curve moves lower. Now, during the rate hiking cycle, some of the worst performing sectors in the bond market were actually the highest quality. So treasuries, investment grade corporates, mortgages all perform particularly poorly as they generally have longer durations and more sensitivity to interest rates. Now that the tide is turning, this is likely going to be changing. Here at Westwood, we have been increasing some of our exposure to higher quality bonds, reducing some of our exposure to some of the lower quality sectors like high yield and even lower quality investment grade. Now, this is because credit spreads are tighter. They're tighter now than they have been at many times in the past, and now yields are beginning to fall. So you're getting a little bit better risk reward in simply owning some of the higher quality treasuries that performed so poorly the last couple of years. One other dynamic within the fixed income market is that bonds are now providing that safe haven that we're all used to. During the Fed rate hiking cycle, when they were focused more on inflation, we saw treasury yields move higher. We saw equities sell off at the same time. This meant that bonds didn't provide that downside protection and that volatility reduction that they have typically provided in a multi-asset portfolio. We believe that is likely changing. As the Fed's focus shifts from inflation to the labor market, bonds are once again providing that attractive downside protection and volatility reduction that is so crucial in a multi-asset portfolio. Now, let's spend a little bit of time talking about the equity market and some of the implications of a falling Fed funds environment. In general, if the Fed funds rate is falling for the right reasons, meaning we're not entering a recession or trying to play catch up after entering a recession, then we expect equities to generally perform quite well. There are some sectors that we think are really poised to outperform, one of them being real estate sector. Now, REITs were hit by the double whammy of COVID and the working from home, and then the rising rate environment. This means that equity valuations are very depressed. When we look at price to cash flow multiples, they are extremely low versus history. We believe this is now going to change as we have the tailwind of lower rates, and as a result, we have been increasing our exposure to the real estate sector, and it's now one of our most favored sectors across multi-asset portfolios. Another sector we expect to perform well is the financial sector, particularly banks, as lower Fed funds rates means that cost of capital decreases and margins improve. Investment banking divisions are also likely to benefit from increased deal activity in a lower rate world as cost of capital decreases. And as a result, we continue to remain overweight the banking sector. Utilities are one last sector that generally performs well in a falling rate environment. Apart from the sector level, I wanted to talk a little bit about small caps and medium cap businesses. Small caps have really underperformed their large cap peers. And a reason for this is that small cap companies generally carry more floating rate debt than their larger peers. This floating rate debt is priced off of short-term bond yields, which has been a significant headwind for company interest expense. This is now going to start shifting as falling yields on the front end mean that their coupon expense is going to start to come down. As a result, we've been increasing our small cap exposure and expect to continue to do so as financing conditions improve. Historically, growth stocks were always deemed to be winners in falling rate environments, as long duration cash flows were discounted at lower interest rates. This has the possibility to continue this time around, but we are entering this cycle with large caps companies trading at very high multiples and following a real bull market run for some of the largest growth companies out there. One offset to this could be the money on the sidelines that is poised to re-enter the market. As treasury bills rose, investors were incentivized to park money in cash and cash alternatives that were yielding north of 5.25%. As this begins to change, we expect that this money will re-enter the market. To the extent that this enters the market through passive S&P 500 funds, that will largely get invested in large cap growth, which could offset some of those valuation headwinds. Lastly, just wanted to touch on convertible bonds. And we've been increasing our exposure here to take advantage of some of those attractive valuations that we're finding in both small and medium cap businesses. Convertible bonds have the added benefit of giving you that downside bond-like protection when it is most needed. All in all, it's an exciting time for multi-asset portfolios. 2022 and the first half of 2023 were a challenging environment as bond prices and equity prices largely moved in tandem. We believe that this is changing and presents many opportunities for our portfolios to perform well and provide both income and downside protection without giving up the potential for upside appreciation. Thank you very much for joining me today. I hope everyone has a great week and we can finally stop talking about when we'll see the first Fed rate cut.